Have you ever looked at a business's finances and had absolutely no idea what any of it meant? Yeah, same. Today we're going to fix that. This is Accounting Basics. Everything you need to know, explained simply in less than 7 minutes. So first, what even is accounting? Accounting is basically the system businesses use to track money, where it comes from, where it goes, and how much is left. Think of it like a scoreboard for your finances. Without it, you'd have no idea if your business is winning or losing. Now, accounting revolves around three big documents: the income statement, the balance sheet, and the cash flow statement. These three reports tell you almost everything you need to know about a business's financial health. We'll cover all three. Don't worry, they're simpler than they sound. Let's start with two key terms: assets and liabilities. Assets are things you own that have value, like cash, a car, a building, or equipment. Liabilities are things you owe, like loans, credit card debt, or unpaid bills. The difference between the two is called equity. That's basically what the business is actually worth once you pay off everything you owe. This brings us to the most important equation in all of accounting. Ready? Here it is. Assets equals liabilities plus equity. That's it. That single equation is the foundation of everything. Every financial statement, every transaction, every report, it all ties back to this. Tattoo it on your brain. Now let's talk about revenue. Revenue is the money your business earns from selling products or services. When a customer pays you for something, that's revenue. It's also called your top line because it shows up at the top of your income statement. More revenue generally means things are going well, but revenue alone doesn't tell the full story. You also have expenses. Expenses are the costs you pay to run the business: rent, salaries, electricity, supplies, advertising. Money flowing out. Every business has expenses. The goal is to make sure your revenue is bigger than your expenses, which brings us to net income. Net income is simply revenue minus expenses. If revenue is bigger, congratulations, you have a profit. If expenses are bigger, that's a loss. Net income is also called the bottom line because it literally sits at the bottom of the income statement. It's the number everyone cares about most. Which brings us to the first big report, the income statement. It shows your revenue at the top, your expenses in the middle, and your net income at the bottom. It covers a specific time period, like a month or a year. It's basically a summary of how profitable your business was during that time. The second big report is the balance sheet. It shows what the business owns versus what it owes at a specific point in time. Left side, assets; right side, liabilities plus equity. And here's the key: both sides must always be equal. That's why it's called a balance sheet. It always balances. Now let's talk about something that confuses almost everyone: debits and credits. In everyday life, debit means money leaving and credit means money arriving. But in accounting, it's different. Debits and credits are just the two sides of every transaction. Debits go on the left, credits go on the right. That's it. Accountants use something called a T account to track this. Picture a big letter T. The left side is for debits, the right side is for credits. Every account, whether it's cash, expenses, or revenue, has its own T account. Numbers go in on one side or the other depending on the transaction, which leads us to double entry bookkeeping. This is the rule that every single financial transaction affects at least two accounts. One account gets a debit, another gets a credit. Always. This system keeps the books balanced and makes errors much easier to catch. It's been used by accountants for over 500 years and it still works perfectly today. Here's another big concept: cash versus accrual accounting. Cash accounting is simple. You record money when it actually moves. You get paid, you record it. You pay a bill, you record it. Accrual accounting is different. You record revenue when it's earned and expenses when they're incurred, even if the cash hasn't moved yet. Most larger businesses use accrual accounting because it gives a more accurate picture of financial health. The third major financial report is the cash flow statement. This one tracks actual cash moving in and out of the business. It's broken into three sections: operating activities, cash from day-to-day business; investing activities, cash from buying or selling assets; and financing activities, cash from loans or investors. A business can be profitable on paper but still run out of cash. This statement catches that. Let's quickly cover depreciation. When you buy a big asset like a car or a machine, it loses value over time. Instead of recording the full cost immediately, accounting spreads that cost out over the asset's useful life. This is called depreciation. It's why a car you bought for $30,000 might only be worth $10,000 on your books a few years later. So why does any of this matter? Because accounting gives you the information you need to make smart decisions. Should you hire someone new? Can you afford that equipment? Is the business actually growing? Without accounting, you're flying blind. With it, you have a clear financial picture of exactly where things stand. Let's recap. Accounting tracks money using three main reports: the income statement, the balance sheet, and the cash flow statement. Everything is built on one equation: assets equals liabilities plus equity. Revenue minus expenses equals net income. Every transaction has two sides, a debit and a credit, and cash flow keeps the whole thing running. That's accounting. You just learned it in less than 7 minutes. Not bad.